Good afternoon, everyone. Hope you're all having a wonderful day on November 4th, Election Day. Well, it's a big day today and big day in the market today, and we have all kinds of things to cover. So we're going to cover, first of all, give you an update on the government shutdown. And then, as you know, the Federal Reserve met last week and had a big federal decision, interest rate decision. We'll talk about that. And then there's some new tax update. I'm going to go over some of the changes that were just announced for 2026 as far as taxes and Social Security. And then the most important thing you all want to hear is, what do we think about the markets? What's going to happen between the end of the year and next year? And then we're going to introduce some of our new associates that have joined our firm. And then we'll end with some year-end tax planning. But most of all, mark it down before I even go any further, that we're gonna have a big podcast. Last one of the year will be Thursday, December 11th. So mark it from now. All right, so that's the agenda. Now, first question is about government shutdown. It's on everyone's mind. It's right now. Tomorrow would actually be, I'm sure the government will still be shut down tomorrow, and that will mark the longest government shutdown in history. And it's going to last a little while longer, hopefully not that much longer. But what I want to know, Dryden, is what effect does it have on the stock market, if anything, or the earnings, most of all on the psyche of people, and why is it happening, and when do we expect it to end?
There's a couple of things going on there. First of all, government shutdowns usually don't have much effect on markets. They create some angst. They create, lots of headlines, lots of news. But in general, even though this is rapidly becoming the longest one we've had, they don't happen for long enough to have a severe impact on the economy. They sometimes affect data. They affect information that the Fed uses, that the government uses. But a lot of times this is big wind, loud thunder, no rain. And it really affects those people that aren't getting paid. And it's somewhat ridiculous. As you know, I fly a lot, and I remember the other day as I'm going through the line to thank the TSA people. For any of you who are flying, make sure that you thank the TSA people and the folks that are working without pay right now to keep your travel safe. But I think the issue here is this does end. Why has it taken as long as it has? You have a couple of milestones that occurred. Originally, it was always going to go to that following Tuesday because they couldn't do it because you had Yom Kippur in there. The next thing is they wanted to hold it. The Democrats wanted to hold on to it till they got to No King's Day, so that was the 18th. So you extend it out to the 18th because they wanted to use that as the No King's Day was a big series of demonstrations that were supposed to happen. And that was the shutdown was on part of that. So then when they got that far, they wanted to make sure that they hold it past today, because playing to the base of the Democratic Party, they want to make sure they hold it because now these are the elections in many states that had to do with redistricting. Now, interestingly enough, if the blue states go for blue state redistricting, the red states go for red state redistricting, and everybody does their redistricting, it's a net zero change in terms of what the dominant party has and the dominant stuff. So the swing states will still be the swing states, and the solid states will still be the solid states, and the net outcome of the House will probably be the same. But that's what a lot of this election that we're having today is all about. So now, back to shutdown. They've held the shutdown till now. They want to make sure that they're mobilizing the base. And now, once we get past this, tomorrow, everybody will declare some form of victory in the midterms. There'll be enough for both sides to declare some form of victory. And then what they'll do is Schumer will probably release a certain number of his senators to be able to vote their districts. And that means you're going to see people like Fetterman, Durbin, a few others come over, and they will vote their districts, and then you need about 5, and then the shutdown will be over. So this could be over as soon as the weekend. The House of Representatives rules they have to have 48-hour notice rather So the soonest they could vote would be Friday. The other problem is that the bill is going to come back to the House with some changes because the current bill only funds the government to November 21st. So, like, why do that? So you're going to come back with it's all going to be about dates, and they'll probably pick a date sometime out in December, and they'll fund it to then, so they can start this whole thing all over again to have the debate about the COVID tax benefits. So the real thing for everybody to know is this: government shutdown's going to end. It'll probably end within the next 5 or 10 days. They'll probably extend it out, funding the government out to somewhere close to the end of December. And in the period of time, they will go ahead and debate. Now, they have 3 of the 12 appropriation bills done, so they maybe just pass those now too, and then try to get the other ones done.
Well, the most important thing from what Dryden's saying and what we're saying is that we should have some sort of resolution probably by early next week, which is very good because all these people traveling for Thanksgiving, including us, want to make sure that we don't. People were back. Most important thing is we had a Fed meeting and the Fed reduced interest rate by 0.25% this last time. And people are saying, well, inflation is still relatively the same. So why did they reduce rates? And what can we expect for the December next year in terms of what
Sure.
rate
Well,
reductions?
you remember we were at 5.5 for an entire almost year, and then they dropped it to 4.5 for almost the entire year. So now that we're at 4.5, now we've dropped it down to 4. We've had 2 rate cuts. Chances are we're going to have another one, and that other one will probably come in December or the following meeting in January. The issue is it's not whether or not you're going to have the cut rate. It's whether it's within 30 or 60 days of whatever period of time. The reason why they went ahead and cut now is they really didn't have any data. And in December, they're not going to have enough data either. So even though we open the government back up, it takes a while to collect the data, analyze the data, do the data, all of these things. So in general, you're probably going to see, you may see another cut in December. And if you do, then they'll probably stand pat in January, February, because they want to, wait and see what's going on. If they don't cut in December, then they'll, do January or February cut. So, but I really think where we're going to end up is 375 here for a little while, and then get better data, and then they'll see if they're going to take it on down to 350 or something like that. I mean, right now, the long-term view is that the neutral rate, which is the rate at which neither stimulative nor restrictive, is probably 3. So the question is, when do we get to there? Right? When do we get to there? And that's going to be driven by inflation, and that's going to be driven by inflation days. And one thing to remember, too, folks, is if you want to get a good gauge of how hot or cold inflation is running, take a look at oil prices. Even though we exclude food and energy and a lot of stuff, when you take a look at how things work through normal, American consumer, right? Oil prices really drive a lot of that, and we've got a low oil price right now, lower than it's been in a while. We've got West Texas Intermediates going like $60.80. A couple years ago it was at 80. So I think that you're seeing the American consumer being in a position where the lower oil prices are helping them, and I think that we're seeing that kind of work its way through the economy.
Okay. Now, what's interesting is we just got the announcements as far as the increase in Social Security next year. And what I found interesting is that last year they bumped Social Security by 2.5%, even though inflation was higher than that. This year, inflation was lower than that, but they are bumping Social Security benefits next year by 2.8%, which is very good for retirees and those who are receiving Social Security. But I found it interesting, it's higher bump than the prior year, even though inflation is down, but we'll take it nevertheless. But they really, really bumped up a lot of other things that I want to go through. For example, the 401k contribution for 2025 is 23,500. That got bumped by a whole $1,000. So next year limit would be 24,500. And then for the very first time in a long time, the catch-up provision also got bumped up from 7,500 to 8,000. So for those of you who are over age 50 next year, you'll be able to put the 24,500 plus the 8,000 in your 401k contribution. They also bumped the total for 401k contribution totally from 70,000 to 72,000. The 457 also got bumped from 23.5 to 24.5. But here's my favorite. For a long time, they haven't done anything with the IRA. IRA, it's been 7,000 for many, many years. Next year, it'll be 7,500. That's the same for regular IRA or Roth. And then they bumped up the catch-up provision from 1,000 to 1,100. So if you're over age 50, next year you'll be able to contribute $8,600 instead of 8,000 that you're doing this year. And if you're under 50, obviously it'll be 7,500. And those dollars help, especially if you're doing IRA contribution for your children or your kids, or doing backdoor Roth IRA or backdoor IRA. That extra $600 if you're over age 50 is substantial. And as you know, there is a special contribution for between age 60 and 63, where you can put additional money into your 401k contribution, and that also got bumped up from let's see, from 11,000 to 50 to 11,500. So you'll be able to contribute almost 11,500 between age 60 and 63. Now, next year, if you're making a certain higher income, that has to be a Roth contribution, which we favor anyway. Also, all the tax rates went up as far as your marginal rates, where you can earn more income before you go into a higher tax bracket. So those are
The
really
the rates did not go up. The brackets
went up.
The bracket
expanded.
Yeah.
And for those of you who hopefully you'll all be joining us on our luncheon, which is April 25th, the last Saturday of April next year. We will have a whole presentation on some of these changes and how to take advantage of them, so do not miss that. But the big news is our contributions are going up, 401k contributions are going up, and your Social Security income is going up by 2.8%. So it's all really good news to look forward to next year. So with all these wonderful things, Jordan, we've had earnings season.
Mhm.
We just almost toward the end of it. We've had a lot of earnings the last couple of weeks, including today. So can you give us an idea of, are we beating the earnings? How are we in the earnings?
You've had about 370 out of 498 companies report, and on average, 82% of the companies are beating their earnings estimates. And this is significant, and there's a lot of things going into that. One of the things you have to pay attention to, particularly in small mid-cap companies, or companies that are manufacturing and things like that, where they have interest cost is part of their cost of goods sold, part of cost of doing business. So remember, interest rates were 5.5, then they went to 4.5, and now they're headed down to 3.75. When you lower the interest that's charged on your carry, and you lower the interest that's charged on your cost of goods sold and your inventory and all those things, that money becomes accretive to earnings very quickly. So in this lowering of interest rate environments, you see also margin expansion. And so that would turn into greater earning speeds. So a lot of this, folks, is just math, and it's how the math works. And so part of this is we're seeing increased earnings beats. We're also seeing that the economy kind of chugging along better than people thought. Everybody lowered their estimates during the first quarter because they were worried about the impact of tariffs. The impact of tariffs has not been as negative as people were thinking or projecting, and therefore now you're looking at continual earnings beats, and it looks like this is a trend that'll probably continue on through fourth quarter. So we'll see similar thing going on next year. So we're pretty positive on earnings.
So we've talked about, I get clients calling me every day. What's going to happen to the market? The market is high, isn't it too high? And you know, we always say earnings are going up, the market should be going up. Earnings follow the
Market
market.
follows earnings.
Markets follow earnings. And so we know there's three catalysts, three big things that are happening right now, and certainly will happen next year, that we think not as many people talking about, that we think are gonna drive the market. Can you go into details, those three catalysts? for
Yeah,
me?
well, there's actually a few more than that, but I want to take deeper on this earnings thing just a little bit, because you're going to ask me like, going forward is that, you know, people go like the market's high, the market's high, the market's high. The point of the matter is earnings went up this year 13.9%. So earnings are up 14%. The market's up 15%. In other words, it makes sense. If your earnings are at an all-time high, your market's going to be at an all-time high. If it wasn't, then you'd kind of wonder what's wrong. And when you look at it, you know, we have the catalyst for next year. You got a couple of them. You have this AI build out. All the capital expenditure there tends to be accretive to the companies involved in that. You also have this function where you have AI beginning to show up in labor productivity. Higher labor productivity tends to increase earnings. But then you also have, as far as catalysts of the economy in general, you have the results of the great big beautiful bill. And there's issues in there that lower taxes. There's issues in there that increase revenues. There's issues in there that are stimulative. Remember, we've talked about this before, is that the tariffs were increasing. The tariff's going to increase revenue, right? Greater than the one great big beautiful bill was going to spend. Because then at that point, it would do two things. It would be net stimulative and also beneficial to the deficit. And it looks like that math is working out. It looks like that math is working out. And so you find yourself in the situation that the elements of fiscal policy are stimulative to the economy and also beneficial to the deficit. In other words, helping to keep that somewhat under control. The other big thing that you have going on is you've got lower interest rates. So you're going into successful stimulative fiscal policy and successful stimulative monetary policy at the same time as you have a general transformational factor going on in both capital spending and labor productivity. So all of these things kind of move us towards it's a positive next year, barring any strange thing happen. And interestingly enough, there's something that people are forgetting. When they did the great big beautiful bill, they didn't they changed the tax rate, but they did not change the withholdings. What that means is next year there's going to be about $150 billion refunded to the American taxpayer because they've over withheld. And there's going to be about $100 billion refunded to American corporations because they over withheld. And so now you have this stimulative nature coming in probably in the first half of the year. So all of these things are combining to make us feel pretty comfortable with the idea of the earnings expectations next year being about 12 to 13% higher than they are this year. What does that mean going forward? Well, if earnings are up 12 or 13%, then the market's probably going to be up 12 or 13%. So the important thing is to understand which companies are going to have better margin expansion in this generally stimulative environment.
Because when you give people refund, what do they do, Dryden?
Well, what does anybody in America do when you give them money? They spend it.
They spend it.
And
When
so
they spend it on goods and services that companies make, and those companies make more profit. The other big thing is what Dryden was talking about is interest rates going down. Money grows where it's treated best. Every other day I get a client calling me and saying, you know, I had a CD come due. I was getting 5%. They're only offering me 3.5% right now. Can you please take it and make me more than that? And so the competition for the market was, you know, the 5% and the 4% rates that you were getting in the bank, which no longer will be as interest rates are dropping. And we, as Brian said, they're going to drop even more so, potentially in December, a couple more next year. So the demand for investing in stocks, if the earnings are there, are going to be quite good. Also, artificial intelligence is making company so much more productive. And it's all about being productive with the same number of employees. We call it AI plus H. It's artificial intelligence plus human. We're not going to get rid of human. I know I get clients that are saying, "Oh my gosh, all these people are going to be out of work. If AI is going to take over." I know, I'm sure they've had those same conversation when there was a horse and buggy and the cars came in and all the other things that all the revolutions that we've had. We think the AI revolution is as big as when electricity came into this country. Without electricity, factories could not work, be open 24 hours if they so choose, and all those things. I mean, you can imagine what electricity did. We think AI is as big as what the electricity is to our economy and our country. So we do think there's three big catalysts. That's not without saying that we're not going to have some volatility and a 5 or 10% corrections along the way. Those are healthy. We had a little, market drop today, primarily because of some short sellers that came in there, wanted to short some AI stocks. And of course, with the algorithm that always drives a little bit of selling, which we think is usually things like that, they're not based on fundamentals, tend to be short-lived. So that's kind of what happened today. And we're still, we think any sort of corrections or downturns or so forth could be good opportunities for companies that have good earnings. As Dryden said, 82% of companies have good earnings, and then they're projected to have good earnings because AI is going to make them more profitable. So that is what we think. The other thing that has happened to our firm, which we're really excited about, is that we've just been ranked number 11 registered investment advisor firm in the country by Forbes. We moved up actually from number 13, so we're very, very proud of that. Our assets under management have grown. Just Pence Wealth Management alone has grown to $2.8 billion of assets. That's thanks to all of you, your confidence in us, your referrals, which we appreciate very much. And with that, we have added fantastic 4 newcomers to our firm, which we're really excited about. I want to just, you should have already gotten a picture from Ruben, who's our wonderful marketing. Here they are. And we are very, very excited about the talent that we brought on, because really we look for very talented people, and we also look for advisors and team members that have a servant's heart. And we looked long and hard before we brought on these 4 amazing people. 2 of them are advisors and 2 of them are associate of the advisors. So let me just briefly tell you about Maya Park. Maya is the first one here. She's absolutely beautiful. Not only that, she's very smart, very talented. She has 20 years of experience in private wealth management and has already been recognized as Forbes' top women wealth advisors in the best estate list for 3 consecutive years. So she comes very highly ranked, and she is a certified private wealth advisor. Her associate is the one at the end, which is his name is Mac. Mac supports my and other advisors as well. He is holds a Series 7 and a 63, and he's amazing to work with. Very much a person with a servant's heart. Then we have Ryan. Oh, by the way, Mai is married with 2 boys. Ryan is married with a 15-month-old boy, beautiful boy. And he has 2 decades of experience in the wealth management. He holds multiple advanced designations, including certified investment management analyst, certified exit planning advisor, and certified plan fiduciary advisor. And he brought with him his assistant, Natalie, who is amazing. She has 11 years of experience, and she's known for her client first approach. She combines strong financial knowledge with a background in hospitality to deliver a truly personalized client experience. I can't tell you how excited we have. You're going to be meeting all of them. You'll see some of them with me on the various meetings we have with you, introducing them and adding them to the team. We're growing so much, we're adding more office space downstairs so that we can accommodate the growth and to serve you better. So very, very excited about them. So please welcome them when you see them to our firm. Okay, so with that, just a few year-end planning ideas that we want to make sure if you have not done your required minimum distribution, please, let's get those done. I know the team has been calling and making sure so we do the right withholdings and so forth. And then, as you know, part of the big beautiful bill is the ability to deduct up to 40,000 of SALT deduction, which is property taxes, income taxes. So if you're making under 500,000, you'll be able to take advantage of the full 40,000. But you need to make sure if you have your property tax bill, that's usually is paid over two installments, one in December and one in April. You might want to pay both of them this year if you're within that range. If you have a state income estimates that would be due in January 15th, you might want to pay this year. If you have a mortgage payment that you normally pay in January, you want to maybe pay it in December. So take advantage of the tax benefits that are available this year under the big beautiful tax bill so that you have some of those refunds that Brian talked about. It is huge, this $150 billion of refunds, because many of the tax benefits that are in this bill have to do with middle America and has to do with things that really are not going to be showing up until you file your tax return, like the SALT deduction, like the credit for Social Security, or people over age 65, $6,000 per person, so forth, if you're under certain income. So a lot of these things will come in next year, and people will get some refunds that they were not counting on. So we're very excited to see that. So with that, any last words, Dryden?
Yeah, I mean, I think, obviously we'll have another meeting in December,
11.
Another podcast, and you got a few things going on here. But what's important for people to recognize, we'll have a little volatility. We always do. You get some year-end planning and things like that. The market's going to flop around a little bit, but fundamentals still remain very strong. Fundamentals are what drives the economy in the end. And like I said, if earnings are at an all-time high, it makes sense for the market to be near an all-time high. Earnings are going to go forward into next year, so we're constructive to next year as well. And it's just basic math. And
So with that, have a great Thanksgiving, the end of the year here, the end of the month. Please tune in Thursday, December 11th, the day after the Fed meets. So we'll give you an update about what the Fed will have done in December. And thank you all for your confidence in us. And we will talk to you on December 11th.
Layla Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Dryden Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. The financial professionals affiliated with PWM are registered representatives with, and securities and investment advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Pence Wealth Management PWM and LPL Financial are separate entities.